Hello, everyone, and welcome to the Business Spotlight podcast, where we shine a light on the incredible entrepreneurs and business owners in our community. I'm your host, Craig Whipperman with Music City Action Coach. And today we're excited to introduce you to someone who is blazing a trail in the streamlining of investment processing here in Nashville. Our guest today is Brian Harstine, founder of Acquire Invest. We'll dive into Brian's background, explore the challenges he's faced, and the successes he's celebrated. Whether you're a fellow entrepreneur, an aspiring business owner, or simply someone who loves to support local businesses, this conversation is sure to inspire and inform. So without further ado, let's welcome Brian to the podcast. Brian, you doing okay today?
Absolutely. Great to be here, Craig.
Yeah, looking forward to the conversation. Yeah. So, Brian, you were sharing with me your history is in private equity, and that's the roots of what your latest venture is. Tell us a little bit about Acquire Invest and how it's come to be.
Yeah, great question. Look, what we set out to build was solving problems that I faced when, I was working in the private equity world, doing a lot of the back office, middle office processing, communicating with that front office when we're onboarding investors into these different deals. We worked on a lot of different deals across multiple verticals, everything from real estate to entertainment. Even a NASCAR team was in there. But yeah, essentially, I just noticed there was a big issue with efficiency. Everything was sitting on old systems. We're talking Excel spreadsheets. Occasionally, they're using other systems that require manual input to process some of this. Some of the more advanced, sophisticated teams out there are still, bouncing between multiple systems to accomplish their day-to-day work. And in this day and age, I don't think that is a good way to do business. There's a lot of efficiency gains that can be had, and we decided to set out and solve those problems by connecting a lot of those disconnected, siloed systems, those departments that sit, in their own function, sort of separate from each other, but really working towards the same goal to support these funds, whether it's venture capital, private equity, hedge funds, SPVs, whatever you're taking to market. You're essentially an investment product, and we're trying to connect and really create efficiencies across that scale. But we're taking it a step further this coming year.
Taking it a step further.
Yeah. Don't want to get too far into it, but we have some exciting things we want to be working on. We are in the middle of a raise ourselves to sort of support a couple of these very large clients that we have, lined up for the business, that want to launch in Q1. And a few of the exciting pieces are around integrations. I think everybody probably uses something like a Slack, and they connect all of these other systems that they use in their day-to-day world to their Slack, so they can have this sort of hub, this sort of single source of truth, between just that type of chat. So what we're doing is expanding our system beyond this end-to-end platform that connects these departments and processes, information of onboarding investors through, their capital commitments and capital transfers. We're going further to connect that to other tools they use for, say, tax purposes, aggregated reporting, and potentially some exciting elements around distribution. So, the idea of publishing your said offering or private equity deal or venture capital deal out to multiple different platforms to find investors from multiple different locations. So there's a handful of really exciting tools there. We're really focusing in on that hub mentality and bringing that data into a unified experience, something that I think is greatly lacking in this business. Everybody is very fractured and fragmented to accomplish these things, and it creates cost, which cuts down margin, which cuts down, or increases the fee to the investor as well. So I think we're going to see whether we're the ones to accomplish it or others in the market, but I think we're going to see a major change over the next 5 to 10 years within the financial services space, and it's going to be focused around this.
Yeah, very interesting. So, you know what? Segmented, siloed departments and companies have been in existence for quite some time. I remember company I worked at, we went through a massive overhaul, but we had developers internal to the company who developed like, custom platform for us to focus in on our business. This seems though that it has, well, obviously across the whole investment space, are there other markets beyond or is it yours so customized to the investment world, where it might have a home outside?
Yeah, I wrote an article not long ago about really focusing on niche markets and the ability, these broad scale platforms. Think about Salesforce, for example, right?
Hmm.
Salesforce serves everyone,
Hmm.
but in that they sort of lack the specificity to make certain businesses very efficient, right? It requires now a Salesforce engineer to come in and help you set up a Salesforce platform and make it very tailored to your business line, the type of sales and the type of pipelines you're building, and then try to connect that to all these Salesforce apps that you might be using other softwares outside of that. Now, that's what I would consider like a general purpose application, not industry specific. We are very, very much so industry specific. I think there is a lot more deeper penetration in this market that we can have by being more focused. Also, it's sort of indicative of how we build based on rules, regulations, and compliance that pertains to this industry. It's highly regulated. There's something like 53 organizations across the United States that kind of govern what you can and can't do within financial investment markets. We focus even further on just specifically private markets, so none in the public space. Whereas some of the hedge funds that may deal with public assets may still use our platform in some ways, primary issuance and some of the operational tools. But we're not dealing with the public sector. We're also not really focusing on super early emerging managers. These emerging managers that are out there, I think there's a lot of great solutions that they can utilize. Emerging manager problems tend to be around, what is the team that I have to have? Who do I bring on to help me with my legal, my compliance, my fund administration, the tax, K1s that I'm going to have to generate for my LPs? And, they don't know all of their system yet. They don't have those things in place. So there are other platforms out there that are very well catered to this. While we can work with emerging managers, we tend to be able to work best and optimize groups that are in the middle market to institutional grade or enterprise grade. What we're focused on within that is augmenting those departments, right? And allowing them not just to connect to themselves, but really upgrade the way they do business now. Get a little bit more of a modern experience, modern UI, provide something to their customers that their customers probably don't have right now, which is an actual interface. It's like a white labeled prosumer Robinhood, if you will, that each individual group would have. Except we don't do trading. That's a key difference.
Mm-hmm. Okay. And so, yeah, so, my understanding and knowledge of that whole space there is, I would say, roughly with very limited, but the, you know, I'm really curious. You honed in on the fact that it's highly regulated. I'm wondering why no one else has kind of seen this as an opportunity before. Have they been scared away maybe by the regulation? Do you have to have someone of your experience having lived in it to see the opportunity? Why haven't there been solutions to kind of, streamline this and make it more efficient in the past?
I think there are people working on that, right? And they have in the past been working on it. I think we're in a very unique catalyst moment in history where you're looking at Web 2 solutions that are starting to age out, and you have these like Web 2.5, and even looking forward into blockchain and Web 3, where they have to be thinking about how can I be forward compatible to the markets that we're looking at in the future. And I think there are a lot of people solving this problem. for different sections of the market, and the market is massive. And I can't understate that enough. Just the private market section is something like $13 trillion projected by 2027. That's 13 trillion in annual AUM, so assets under management. So that means all of these funds, private equity, venture capital, so on and so forth, they manage that much money in investments within other, say, portfolio companies or investment deals that they work on. Because of the market being so massive, and because of its work across multiple sectors, you see people solving the problem in different ways from different perspectives. For example, Juniper Square came in and started working on a software platform specific to real estate. But they've since tried to emerge out of just real estate and become more of a general purpose. We can support other types of funds after they really did a good job of moving into that real estate market. But they did start a while back. They've got to continue to innovate, just like everybody does, in order to stay ahead of the market, ahead of like emerging products like ours. We're building on a new modern infrastructure, so it's giving us a little bit of more flexibility. We can move a little bit leaner. We can move a little bit faster towards what we think the next big problem is within the industry. There are people solving parts of it, but they haven't connected all the pieces yet. And I think that is not necessarily because of the complexity of regulation, but generally because there is just so much to build. When you think about all of the elements to build, it took us about 3 years to build up to our state right now. 3 years of development is a decent amount of coding, decent amount of market intelligence that we gained. And that's so that we could service clients at this middle market to institutional level. When you're serving emerging managers, you might not have to build as much, right? You have to build quite a bit when you're thinking about servicing, $1 billion hedge fund. The standards are much higher. So I think barrier to entry is high, so that does deter some people. But those that do enter the market, they've entered it a little while back. So that's kind of how I see it right now. I do see like this catalytic moment where we have an opportunity to jump in and plan for the future here.
Right. Interesting. So how would you describe your moat? What makes you different from other technologies or other entities trying to, get into the space?
Yeah, interesting. So there's a couple ways to look at this. Number one, we are focused on what I think is a bit of an underserved market, which is that middle market to institutional grade or institutional class client. There, again, a lot of them serve kind of entry level to mid market, and that's where a lot of the tech building or the innovation has been focused around. Now, selling to that customer base is a bit harder, right? They have existing operations, existing data. There's migrations that have to occur. So that's part of the barrier why other people haven't pushed into this space. But with AI and a couple of elements that we have available to us, it can help us actually migrate that data in a way that was previously a lot harder and more costly to do. So one of our moats is that we are going after a market that a lot of people have not focused on in the past, not at the level that we are. Those that are focused on it will focus on, say, fund administration only, or they will focus on the tax side or the portfolio management or portfolio reporting side. And where we're sitting is more in a data aggregation mindset. Yes, we're doing this onboarding end-to-end solution to help them optimize, their investments by, say KYC, AML accreditation, document signing, data room is all in there. You're able to process transactions and it updates the whole system. But that's just the first step in these the management process of these funds. When they think about aggregating data on an ongoing basis, the life cycle of that fund and the life cycle of me, the GP, talking to you, the LP, the investor in these funds on an ongoing basis, now I've got to jump into multiple softwares. So I think we have the ability now to pull that data into our system from these other locations in a bi-directional way. So that kind of goes back to my Slack analogy, where you can connect all of these solutions you typically need to operate this complex business that is investment management into one system, and also push out data to other systems from ours. And I don't think a lot of these groups out there have thought about this, not in the same way that we have. I know that there are other people in the market right now that are putting an emphasis on it now. I think they see the opportunity, and luckily we've been building towards that for a while, so we may be able to jump ahead of a couple people. So time is also a second piece of that mode. I think because we've been thinking about this a little ahead of others, we may be able to jump ahead of them in the market. Outside of that, I would say from just a pure technology standpoint, we are looking at blockchain, whereas most others are not. We have what we call an optional blockchain module. So if you want to tokenize a fund, and in Q2 of next year, we'll be able to allow people to invest via a cryptocurrency into a traditional fund, like venture capital fund. Maybe you have some Bitcoin laying around and you say, hey, I'm going to send you some Bitcoin instead of transferring you US dollars, for example. We're going to be able to do that through a multi-asset custody solution through one of our infrastructure partners. So there's going to be this ability to service forward-looking funds. And as we look forward, we're also looking at why would you tokenize? In the history, currently the history of tokenization has been more around a marketing scheme. It's kind of cool to tokenize. There's this promise of liquidity, but the promise of liquidity is not quite realized at this point. There's some great ATSs that are out there now that allow alternative trading on these private market assets. But what is kind of lacking is enough participants in the space. But tokenization is going to enable that type of trading to occur in a more frictionless and cost-effective way. Whereas in the past, it's been a bit cost prohibitive to maintain these type of trades in these lower volume amounts. So with the blockchain module, they can onboard with us, solve their current problems, but also be able to say that we are future proof. We can tokenize at any point. If we want to make this available in an alternative trading system and publish out to say a T0 or like an INX, they'd be able to do that within our system. Most other systems will not have that optionality, and they won't have the ability, again, to move that data back and forth from the other system. They'd probably have to use a third-party transfer agent, adding complexity to the system. Whereas you'd have a built-in transfer agent, and the data would update the same, database. So your ownership table would be about the same, right? It's complex, but it actually simplifies that process, and that's I think the key.
Yeah. So being able to offer that as an option, the tokenization and what you described, that's that. So if it's complex, it implies that it requires a lot of effort from a development perspective to be able to provide it. Is that right?
Yeah, that's right. I mean, once you build it, it should work just the way that it works. We have some pretty hefty infrastructure providers that have also allowed us to sort of skip ahead a little faster. They've seen the vision. They've been working on asset tokenization and providing rails for this type of asset trading for quite some time. This is definitely not a new thing for those that are watching. Blockchain in the securities world, that means compliant wrapped real world assets in a tokenized container. That's started back in 2017, possibly even a little earlier than that. And the Jobs Act sort of helped push along a couple of people that wanted to realize this under Regulation A+ offerings. And now we're looking at kind of a critical point, especially with this new administration, the new SEC chair that they appointed, and sort of the friction is kind of going to, I guess, evaporate and enable some of these companies, including ourselves, to I think move quite a bit quicker.
Yeah. There's nothing like a little deregulation to streamline the development process. I couldn't agree with you more on that. So let's change gears a little bit, man. Let me ask a little bit about you, if you don't mind.
Go for it.
Yeah. So tell us, is this your first venture? Is this the first founding, the first company you founded?
Technically, no. I've been through a few, and I've helped a couple other people build a few as well. And in the private equity side, we not only did due diligence, but one of my tasks was also to work with the founders or of the companies that we were investing in or managing from the private equity firm. So I've actually worked on quite a few different projects. But one it was very exciting to work on this one because I actually got to do it with my dad and my brother. But we had an exit back in 2019, and that was in the insurance space. There was a little bit of technology involved, but we were basically filling a gap in the market where more or less there was not insurance. There was warranties. Warranties were paying out of 33% of these claims, if not lower, and they were charging a decent amount more. So we saw the gap. We worked with another friend of ours, Mark, and ended up launching that. I don't know, and that was maybe 2014, 13, selling in 19.
Mm-hmm. So what in that experience has helped prepare you for this with Acquire?
Yeah, they're very different companies, but I think one element around the sales process, and I did a lot working with the sales teams, selling into boards, typically larger organizations at these water utility companies. I mean, the sales cycle is very similar, right? The way that you look at my targets today, they are also larger companies. There's more politics involved in making the decision to use our software, as it's going to underpin a decent amount of their operations. So the sales cycle and navigating these worlds is similar in that fashion. But in every other sense, they're fairly different businesses. I will say that no matter what business you're in, and I've helped a lot of them along the way, there's a lot of core factors that are the same. People tend to say, well, my business is very different and those rules don't apply to me. But the honest factor is, they do. In many, many cases, there's very, very few exceptions to the rules that govern, sales, and the rules that govern, the way that you maintain your balance sheet, for example. It's very simple. Your OpEx, your cost of goods sold, you track all of those items, no matter if you're a service industry or you're selling a physical product. You build out a spreadsheet, you run your projections, and you see if you've got a fit. The other really, really, really big one is you've got to listen to the market. Build your product with the information given to you by your target customers, but not only your target customers, but your target investors. So when we first built this company, I actually pivoted twice. And I took some learnings from past experiences and past advice that I've given other people, which was take your product, build a website if you want, build a pitch deck, go try to sell it before you built it, right? If you go and sell it to somebody, they're going to tell you why they want it or why they don't. You're not going to be able to give them the product, but they don't know that. Go after them, try to sell your product, and also try to raise money for your product before you're ready to actually raise money. You can develop relationships along the way that are good, but at the same time, you're getting a lot of feedback from these people that should focus your product in, help you find product market fit before you actually start spending money on developing that product, hiring people, building out the team. I think there needs to be a lot more, as we would call, like pre-planning, pre-production, testing, validating before people just jump deep into whatever they're doing. One exception is you're building something that inside and out. You've been in the business, you've been in healthcare for a very long time, and you're just building something very specific that is going to solve a problem, and you already have customers kind of lined up. They know that they're going to buy it. There can be exceptions to that rule, but it typically takes someone that's been in a business for 10, 20 years to see, all of the factors, I guess, around whether it's going to be successful without going through those validating prerequisite steps.
Mm-hmm. So, yeah, you shared about getting your product out there. I remember I worked for a startup for a while, and I think our lead developer said that if you're not ashamed of your initial MVP, then you've released it too soon. And I always used
Yep.
to laugh at that. But I guess there's a fine line to that, because you want it developed enough to a point where you get some constructive feedback, and not so much that it frustrates your customers that it's lacking. Do you find that there's an art to that, putting something out there to get feedback?
Absolutely. I think getting feedback, good and bad. I don't think people really like the bad, but the bad is what you're looking for. There's definitely an
Hmm.
art to it. There's really no bad way to go about doing it, but you have to think about it like a scientific process, scientific method, right? You're testing a bunch of things. You're trying to find penicillin, but that was an accident, right? They found
Hmm.
penicillin as an accident. So you're going to go out with a plan in mind. You're trying to prove a hypothesis, but you have to also be willing to pivot along the way. And as I mentioned, we pivoted within our company as well. Our original goal was to build the Robinhood for private placement assets. Give every retail investor access to similar investments that accredited investors have. And we went out and we tested this. There was immense demand from the retail side to get access and want to invest in things and diversify away from just public assets. But the issue was, as we went to find the supply side, we found that the cost to publishing and maintaining an offering with that many investors was way too high. They were not prepared for it. They were sitting on very old rails, as we mentioned earlier, with what we're building now. Some of these people still were working on spreadsheets. Even if they had vendors doing this for them, their vendors were working on spreadsheets. And that's a huge barrier to creating the market that we found. We didn't really think about solving the supply side problem at that time, but going after this initial goal focused us in on a pivot to say maybe the supply side is where we need to focus our effort. If we're ever going to see the realization of this Robinhood type thing, maybe we're the ones to do it, maybe someone else is going to do it, but the supply side needs to exist first.
Hmm.
So if we can optimize the private market assets and the operations to allow for scale, now they can say, oh, I can publish to these other locations. I don't mind having 50, 100, 200 investors or thousands of investors. Right now the private market is especially in the higher level is designed around, okay, I prefer large investors, smaller amount of them, right? Bigger checks. It's easier to manage, lower cost. And that's typically because our operations today are very, very manual. It's man hour intensive. And there's a lot of hand holding. There's also some strategic reasons why you would only want big checks and fewer people. There's less, investor politics around that. So not all assets will ever want to be published to a Robinhood for private placements, but there's a large portion of that that $13.2 trillion market that would large enough to make another Robinhood exist.
Hmm.
So I mean, will Robinhood end up moving into that space? Maybe. But in terms of your question, listen to the market, the art form around going out to people. There's not a wrong way to do it, but do it with more than one person, right?
Hmm.
If you're the founder, get someone else in on this with you, so that you have two brains hearing information coming back to you at every time. Like, I think that regardless of your individual approach, no one's going to do it perfect. Having multiple people hearing the same person say something is going to give you, a little bit of objective input.
Yeah, no question. Yes, no question. So you mentioned earlier too about The sales part of it being a little bit more political. And I would imagine, and so now I'm really curious, how do you go knocking on doors? And how, because I imagine the sales approach is pretty long and lengthy to convince someone to go with a platform like this even though it might make financial sense. But I'm just really curious, how do you go about making the sale or even knocking on the door?
Yeah, it's a relationship driven business for sure. We're not looking at marketing via Instagram or Facebook.
Mhm.
That's not our target client. It's a lower velocity of sale, a longer sales cycle. It's relationship driven, it's validation driven. When you're selling into these larger customers at an early stage, they're looking for reasons why they should trust a new product, or reasons why they shouldn't. And when you're selling into a larger political world, there's another factor that a lot of people overlook, which is if I recommend this product to my boss and we use this and it doesn't work out, do I lose my job? So when you're selling into these worlds, you have to help mitigate a lot of these points. You almost want to build out your sales pitch to address many of these points up front. And I think those early sales, testing strategies to find what your product should be also should be mapping how to approach that ICP, that ideal customer profile, and who is your champion within that firm. For us, it's the chief investment officer, the CFO, the fund admin, or their compliance team. Those are the people that we right now are affecting the most. We're optimizing their jobs the most. They see the benefit the most within the organization. The top end guys, they're going to see other value out of this, and they're going to also turn around and say, okay, from you guys down here, they're doing these, interacting with this platform. Why do you recommend it? Right? Is it going to help our bottom line? Because that's what most of these larger groups are looking for. They're looking for increased margin. How can we sell faster, provide a better experience, be more competitive in the market? Otherwise, they'll just keep doing what they're doing in the same way they're doing it. What you have to give them, in my opinion, a 10x better reason, if
Mhm.
not more,
Mhm.
from what they're doing now to what you're offering.
Right.
And it's not just price driven. When you're selling into larger organizations, price is less of a factor. It's definitely a factor. They have to budget for sure, but you don't have to undersell. You don't have to undercut. Only to the point where if you have a couple competitors that you've clocked and you know what their pricing is, you might want to just barely be a little cheaper, so
Mhm.
that they can't say the other one's cheaper than you. At least until you build enough validation within your system. Now, on the sales front for new companies selling into these larger or bigger businesses, the challenge is they always will ask who's using it now, right? Why should I be the first one to use it? And they won't be the first one to use it. So you have to get really creative to find those first customers, incentivize them in the right way, de-risk it for them, probably give it away for free, or it's in some form or fashion. But once you get through that phase, you now go to these other sales and they say, well, who's using it? Well, we just finished projects with this guy, and this guy,
Right.
right? And you want to target a couple of really big players that I would consider, that first domino.
Right.
If you can land one of those, the purchase validation is just there. So I think you're not going to accomplish all of this at once, but it's got to be part of the plan.
Right. Right. Yeah. There's a level of social proofing, I guess, that goes into that, right? If so and so is using it, well, it must be good enough, then I can take the leap. Yeah, and so 10x, it's like if you're not 10x and you really don't have it, I don't want to say you don't have a chance, but that's the target, right? It's not worth it for them to move unless there's 10. Have you been able to quantify the savings and the efficiencies in certain
To
environments?
for some verticals so far, but not for all the verticals we're selling into. We're going to launch some new customers and some new verticals next year, and we'll be able to work on some case studies that are going to be really effective at selling into those verticals, moving forward. But we've done numerous tests ahead of time to illustrate where the efficiency savings come in, but it also is a moving target. Each customer is different. Each customer's internal operations is different. This team over here might have 15 people, but this team over here might have 10, right? This team over here might use a external vendor to accomplish many of these things, or fractional services, whereas this one has it internal. So their cost basis and their math behind the scenes is different. So when you say I'm going to save you 70%, it's got to be put in different terms, right?
Right.
We do see something about 70% time savings that we're going to see on average. I think some teams it's going to be 30%, but 30% is a lot for some of these guys. For other teams that are maybe a little less lean or less efficient, it might be upwards of 70, and they're not going to realize all that in month one. The problem with some of these things is month 1, 2, 3, you're just getting them warmed up. By month 6, they should be, humming. And then at that point, you can start to measure, right? And during that sales process, we have to obviously explain to them, okay, we're going to help you out through this process. We're going to provide a optional service if you want us to be a concierge during this first 3-6 months, to help you guys work on integrating this platform into your operations. So we're taking that worry, that load off of not only the people that are going to use it, but also the decision makers that are at the end of the day going to say, okay, that looks good. I don't want to put too much strain on my employees, right? I don't want it to affect my day-to-day operations just because we're switching systems. So yeah.
Right. So Brian, let's take a peek into the future, say 5 years from now. Do you have it in your sights to stay with it and grow with it or grow with the company, oversee its growth, or do you have some plans to get it to a certain point and then sell out? Or how many customers are you looking to have on in the next 3 to 5 years? Just paint a picture for me of the future as you guys have envisioned it.
Yeah, most definitely. It's interesting. Some people, I maybe bleeding hearts, right? They say, this is my company. I love this thing. It's my baby. I don't want to let it go, so on and so forth. But, and they might want to take it IPO. They might have these big grand visions. Ultimately, that's great. You have to have, that kind of passion to build anything like this, that entrepreneurial spirit. But at the end of the day, you have to be aware that other opportunities may come, and you need to position yourself to be able to take those at every turn, right? You want to bring it to the board, get consensus. Is today the right day to sell? Is it better for the company to merge with someone else? Are we able to appeal to customers and beat other competitors as a joint unified product? Or is it better for us to stay independent? There's other strategic reasons from an internal capacity, internal calculus, I guess, that needs to be done to figure those things out. But for me personally, I look at these as potential exit opportunities. Could we take this public? Could we go all the way? Absolutely. Companies like AngelList and Juniper Square and Carta and several others have done this, albeit different focuses within the industry than ours. But iCapital, for example, did that. They're one of the larger behemoths out there. But I think that there's other opportunities that we're very well positioned for. And I would suggest to any entrepreneur to build towards your exit. Whether you exit or not, you're building towards it. You're mitigating the risk at every step. Maybe the market takes a turn. Maybe another competitor comes out, and you need to figure out how to keep the business alive. And you need to position yourself to where your business also can make someone else's business more valuable if they buy it. For us, that's probably fund administrators or certain types of larger asset managers or other infrastructure players in our business. So certain neobank type providers, they provide some of the infrastructure behind transaction processing, like TAs, broker dealers, things like that. They may utilize our system and sort of, I guess, add it to their services. But for me, it's really fund administrators. Uh, what we're doing really affects the fund admin. We are targeting them as potential buyers, licensees of the product. But at the end of the day, some fund admin is going to look at this and say, I don't want other fund admins using this, right? This is giving us an advantage that we don't want our competitors to have, so that we can attract more funds, issuers, private equity, venture capital people that use our service to come to us, right? For example, legacy fund administrators out there, they're not really tech companies. They don't really innovate. They might acquire other fund admins, but they're also losing business to tech firms that are also kind of moving in on their space, like Juniper Square and Carta, who have built and bought various fund administrators to augment their software system. Maybe that's in our future as well. But it's a tried and true typical play. But you have to build the software first. Now, will a fund admin come and buy it, like SS&C bought Intralinks back in 2017 for about 1.5 billion? It's pretty hefty exit, and it's definitely something that we're aware that we're building towards. We know that we're going to augment the fund admin's business, that we're going to add value to them in numerous ways that they don't currently add value to their clients, and that in turn should make them more competitive in the market. So I think any business should be aware of their potential exits and open to it, if at all, just to give their investors some risk mitigation. Because along the way, we are fiduciaries in a way as founders, right? They give you money, we've got to go spend that money, but we've got to make something out of it for sure.
Exactly. Yeah. Or the company won't be around too long, right? They want their return. Yeah. So, man, it's been great chatting with you here and learning a lot more about back end processing in the investment world. And you mentioned that. I think that was great advice too. Any entrepreneur who's any founder, at least working towards the exit, whether or not you exit, that's at least a target, right? And then you have the option to do it if you choose. But I think that's great advice. What other advice from a mindset perspective? It seems like, when I interview, especially founders, there's a certain mindset that they have. I'm just curious, what advice would you have giving other founders who are, in the grind, perspective as to what is the right mindset to have?
Yeah. You use the word grind. It's definitely a grind. Some startups will build an MVP and they'll try to prove it out, and they'll give up within the first 6 months. Maybe they'll pivot and keep going for another 6 months to try to find market fit. Maybe they've just proven that the product doesn't work, but at any point, it's going to take you a lot more effort than you initially think to make this thing happen. You're going to have people come and go on your team. That always occurs. It depends on when they're getting paid. I mean, that's the key. A lot of founders underestimate how long it's going to take to be able to pay all of their employees. And, they come and go, not because they don't believe in the product, not because they don't believe in you as the founder to build, this product or build this business. But typically it's because of personal reasons. They might have, family or so on and so forth. So, I would say my biggest advice, knowing that information and knowing, statistics from Y Combinator that they pulled out of thousands of startups and why they failed, most founders underestimated the cost it would take to actually realize their vision. They did not go after enough money early. But that's a push and pull, because investors don't want to give you too much money too early. Right. But I would say your job has to be to raise money as early and often as you possibly can within, the confines of what the market will allow you to do. I'd say, like, again, the Y Combinator element, they point back to these businesses did not fund themselves enough to get through certain phases of the business. And then they had to go back to the market, and the timing didn't work out. They weren't able to, fund the company in time before their last money ran out, right? And they were forced to make some difficult decisions. They couldn't get new money in time. That's one example. Others are bad management of capital, but hopefully the founders are better at that than some of those others. But yeah, those would be my two really big ones. Is it's going to take more than you think, so get ready, buckle up, and it's going to take more money than you think as well.
Yeah, right. Great advice, man. Perfect. Well, like I said, Brian, I really enjoyed having you on the Business Spotlight today. It's been a great conversation, and I wish you the best of luck with Acquire and what you guys are doing. It sounds like you're really, solving a lot of problems there and looking to looking to introduce a lot of efficiencies throughout the industry there. I wish you the best of luck.
Thank you, Craig. It's been a pleasure.
Yeah. All right, man.